You asked about gold. Now, I've talked about this before with you, Reem. Gold is useful as a hedge against sequence of return risk in a portfolio. So there are two major phases when you're an investor. The first is the accumulation phase, and then the second is the drawdown phase. The accumulation phase is when you're earning money and you're adding money to your investments and you're growing your portfolio to get it to be big enough so that you reach your FI number and so that you can live off of your passive income. When you reach your FI number and you start to withdraw funds, you're no longer investing. In that withdrawal phase, that's the time when you face what's called sequence of returns risk. Sequence of returns risk, in short, means that if it just happens that the first, let's say 5 years of your drawdown period, when you're already retired or you're FI, in that first 5 years, if you have a bad sequence of returns, what that means is the stock market is not doing well in the first couple years of your retirement, you are at risk of running out of money in old age. If for the first several years of your retirement, the stock market continues to grow and you're withdrawing 4%, the stock market's going to grow faster than your withdrawals. So you don't have to worry about running out of money. So why would you want gold in your portfolio? The only reason that you want gold in your portfolio is protection during the first several years that you're FI. If the market crashes, gold is not correlated with the stock market. Sometimes when the stock market crashes, gold also goes down, but most of the time when the stock market crashes, gold goes up. So that's the time when you want gold in your portfolio. But gold itself is not a productive asset. It's like a form of currency. It's a commodity. Gold doesn't make new technology. It doesn't sell services. It doesn't create value. It's just a pretty metal that we like and that we pay a lot of money for, right? So the price of gold is affected by investor sentiment, and it's affected by central banks. Like we saw in the past year, gold really skyrocketed because central banks were buying up gold as a hedge against currency risk with the US dollar because of the political situation. So gold can be highly volatile. And that volatility, in fact, gold has a greater volatility than stocks. So if you have your stock index fund and you're worried about volatility and you add gold, you're actually adding more volatility. So a lot of Muslim investors look for assets that can perform like a bond to smooth out volatility and to reduce sequence of returns risk. And gold is one of their options. But here's the thing. Gold can help with the sequence of returns risk in the drawdown phase. But gold does not help balance out volatility of the stock market. In fact, gold is more volatile. It adds more volatility. So the time to put gold into your portfolio is just before you get to the drawdown phase, or in a few years as you're building up to the drawdown phase. So for you, Reem, when you're earlier on in your investing career, you really don't need to be adding gold at this point. There are some people that do, because I have a friend who's Lebanese, Eli Irani. He has a great YouTube channel, Wise Investor Middle East. Just plug him there. He chooses to invest a portion of his portfolio in gold because he has experienced extreme volatility with currency risk living through the banking crisis in Lebanon about 10 years ago. He grew up in war, and so it makes him sleep better at night. But he recognizes that it's not the right choice for most people. So for most people, I would say you don't need to include gold in your portfolio at all. When you are getting closer to FI, it might be the time to add 5% or maximum 10% gold to your portfolio, but not when you're growing your portfolio. That's once your portfolio is already very large, you're almost ready to retire. That's when you would add the gold.